Hello. Welcome, Marlon.
Hey, Austin.
Good to see you here back for another week of Wealth Building Wednesdays. Now,
Mhm.
today we're going to be going in a little bit deeper, right?
Well, a little bit deeper, a little bit kind of options of how to use what we've talked about.
Right.
So,
So let's give it for somebody who's coming on this for the first time, let's give them some context about you and what we've been doing here. This is week number 4. So we've been
right.
doing this every week. We have week number 4. We have one more week of this. But maybe to get started, Marlon, we could bring everybody up to speed on you. Just a quick overview, and then we can get into what we've covered so far before we get it, because I know you have some great stuff prepared
Yeah.
today to really go deeper. Are you
Sure. Yeah. So basically, I grew up on a farm in the Midwest. Farming is pretty much wrapped around debt. And so I had to kind of deal with all that. And I started a journey 30 some years ago going, how do you create wealth? And of course, that journey created a lot of mistakes along the way. And that's kind of what has brought me to where I am today, learning from all those mistakes to create the wealth path that I've been on. And one of the things we've talked about in the previous was mindsets and how we think and who we listen to. Last week we talked about insurance. And of course, we use life insurance as a banking concept. And to kind of recap real quick, some things we can use it for is like an emergency fund. It can be a wealth building fund. And it can also be a way to purchase your vehicles and your real estate. And what's interesting about that, but when you go to borrow money from the bank for, say, like vehicles or like real estate by a mortgage, what is the one variable of that loan that most people will decide that they got a really received a great deal? Let's put it that way. You know what that one variable might be?
with the interest?
Yeah, the interest.
Yep.
So the interest rate is only one part of the variable. Banks want you to focus on that interest rate only. Just focus on that. But really, what you need to
Right.
do is also look at the total interest will cost you over the life of the loan.
Marlon, this is interesting because not to shift gears, but I'm sure we can tie this together because I often think about this with the mortgage of a home.
Hmm.
When you look at these percentages, they want you to look over here, look over here. Here's the rate, this. But in the meanwhile, if you look over here, you realize that this $300,000, $350,000 home is over $1 million, right? If you pay it out or whatever the number is, probably more than that.
Right, right. Yeah, you're paying a lot. So you take a mortgage, you take car loans, you take debt consolidated loans. Those are built where the interest is they call it front loaded. So to give you an example, take a 30-year mortgage. So for the first 15 years, you're going to pay more interest than principal. And the second
Ding,
half, you're
ding,
going to pay
ding.
more principal than interest.
I, I remember this because I remember if you look at your amortization schedule, you can see, right? We
Hmm.
see it.
Right.
And you can probably apply Pareto principle, right? If you look at it, like where most of the money you're putting in, probably 80% of it is interest.
Yeah, you could take it. I don't have it drawn out, but you could take a graph and you put the line at the bottom and you head towards the center of the graph and then upward. That's your principal that you're paying. You're not paying very much up front, and then you take the interest and you're at a higher level, and then it's coming down, and where it meets halfway is about halfway through the note, where you're paying the interest and the principal are equal. But what's interesting, so if you take a 30-year note and the first 15 years you're paying mostly interest, squeeze it down to 7 years where you're even paying more interest and principal. And I don't know what the statistics is today, but I remember before the housing crisis 2008, the average homeowner moved every 7 years. So
That's true. Yeah, that is really, you know, what's interesting. We're talking about real estate, but when you stop and you step back, it's like we're making these decisions with not looking at the right criteria.
Yeah. So then, you would go, well, gosh, why would people do that? Because who made all the money those first 7 years? Well, the bank did, because you didn't pay that much in principal. But the reason people didn't get upset is what we call appreciation. So maybe they paid 100,000 for that home. 7 years later, they got 140,000. They're like, hey, we just made 40,000 off that home. But they didn't really pay any attention to how much the bank made off them. So when you look at the total interest you pay over the life of the loan, that's actually called total interest percentage, or we call it TIP. The TIP is always dramatically higher than the interest rate.
Well, ding, ding, ding. Like this is another, and I hate, this is just, to me, it's like smoke and mirrors, because you start with the interest rate, but it's not the real, when you look at the percentages, it's not the real percentage on the money.
Right. And I'll give you an example. So you take, like you were talking about, 340, let's take a $370,000 home like that, 3% interest rate over 30 years. Your total interest paying out is around 34%.
That's you call your TIP, right?
Yeah. So it's almost like you're buying a house in a third, and a third of the house is paid for by the bank. You literally bought a third of the house for the bank in that regards. So
yeah, it's interesting, Marlon, as we're talking through this, because it's like the bank is trying to mitigate their risk.
Oh, right? They don't.
And in the meantime, we're taking on all the risk because we're having to pay this extra. And I'll tell you, not to go down a rabbit hole, but when you look back, when you go through back in history, as long as we could go, there was a point where people would barter for things, and debt was not common. Like, it wasn't as common, I don't think. I mean, sure, there's debt, but not the way it is grown today. Right. And there's do you know what the word mortgage means?
Yeah, it's like a death.
Payment until death.
Yeah.
That's what the word means. So anyway, I want to get you back on track, because we're talking about the insurance. And what I heard you say is basically you can be your own bank. And so, is that what you're talking about here?
Yeah. So the other type of interest would be like your credit cards, your lines of credit you can put against homes and so forth. And when I borrow from my life insurance policy, those are interest that is paid on average daily balance, meaning there's not that upfront fixed cost of interest. So over time, you're going to pay a lot less interest. And so what I do is I borrow my money from my life insurance policy, borrow against it, but I'm still making money there. And then I go into the real estate side. And part of the real estate that I've gotten involved in is what's called a syndication. It's a group of us that we buy property together. And there's 3 ways to make money inside real estate. There's the cash on cash return. So it means whatever dollars you put into that project, it could be in the syndication. It could actually be into a single family residential rental property. The cash you put in, what is the return on that cash coming back to you as income? In our syndication, we're looking at 8% return on the cash on cash. So if I'm borrowing the money against the money inside my policy, where I'm making a little over 4%, they're charging me 5%. So really my spread isn't very much, but then I'm also making 8% on my cash on cash. But then there's another way to make money, and that's on the depreciation or the deduction. And if you look at a standard single family home, if you do any repairs like roof or windows or kitchens or stuff like that, that's spread out over 27 and a half years, which, I look at that. So I just spent $20,000 doing a repair, divide that out over 27 and a half years.
Minimal.
Not much of a deduction. But what we use is called cost segregation. So what that means is like carpeting, appliances, landscaping. I mean, certain things only last so long. So you hire a company to come in, they do that cost segregation calculations. And so some things are written off at 5 years, 7 years, 50, whatever. but it pushes that deduction up front. So you take a higher deduction. And so literally the deductions we get off the depreciation can offset the income we get off our cash. So
It's
it's
just like
another way
high
to make
level
money.
stuff here. So let's go back and go through it so people can understand it. And
Well, there's a third way. So, and then
Okay.
we'll tie it all together. And the third way is, of course, through value add. So if you increase the rents, do remodeling and so forth, that increases the value to the property, which then when you go to sell it, you're making more money off that property. And then that income is taxed at what's called the long-term capital gains, which is a lower tax bracket than a lot of people pay as ordinary income tax brackets. So to kind of recap,
you got three ways you're making money here off
actually
of four.
Yeah,
off
because
of
I'm borrowing against my life insurance policy,
which is
so I'm
making
making money there.
When
I
you're
make
not,
money
by the
on
way,
the-
let me stop for a second. So when you pull that money out of the life insurance,
Mhm.
so let's just say you got $100,000 in there and you pull out 50. Is that policy still accruing at a rate of, based on 100,000?
Right. It's just like you never took it out because you're not taking it out, you're borrowing against it. It's still in there making money. So
Now,
you're
let me
borrowing
ask you a
against
question.
that.
Let me ask you a
Okay.
question here. What if somebody has a 401k and they're borrowing against their 401k?
They can.
But what's the advantage here with the insurance versus something like that?
Well, for me, I mean, you could borrow that money from a bank and so forth. I mean, you could have a CD in the bank and borrow against it. But unlike a bank with the life insurance policy, if something happens to me and I die, my life insurance policy pays off all the debts,
There you go.
and I still have a death benefit that's paid out to my family, which I can't get with a 401 or
That's a big distinction.
borrowing from a bank and stuff like that. So there's a bunch of other things you can build into those policies that protect you. So it's like you could just have money in the bank, or you can have money inside this to create multiple other advantages. So
Yeah, no, but I like the fact that you brought up this tip concept, because I've heard this before, and it really puts things into perspective about what you're really paying. I think that's the thing that we're getting to here. And then you move into this concept of using this life insurance policy. And by the way, I just want to point this out. It's not like you can hear this and run out and get there's some intricacies and details that Marlon knows. He's been doing this for a long time. There's some things you need to know to set this up. But once it's set up, you're making money off the life insurance policy. And then let's get back to, you said you're making the cash on cash. So let's.
Right. So I can make money. And I should, if you haven't heard about the life insurance part that we talked about last week, it's not just a typical life insurance policy. I mean, we use a whole life, but it's actually, we call it modified because there's some term built into it, and there's rulings and stuff behind it, but you can kind of fund more cash value into that to really, we call it's called a life insurance policy. It's not really a death policy. It's a life policy. And so it's like, use it for a living. But to get back into it, so I borrow against that. So I'm still making money inside my life insurance policy. I take that money and put it into the syndication group where I get money on the cash on cash. I get the deductions that help me protect against taxes. And then the value add creates another income coming in. But what's interesting and what we do in our group is when we add value, we try to, within a 2-year period, when we've added enough value to refinance that project, hopefully pull all our money back out. Then I take that cash, I can go into another project. So think about this. I have money working inside the life insurance policy. Now I have money working inside project number 2. Now I have money working in project number 3. Technically, still the same dollars being used.
Right. So let me just back through my head. So you got the life insurance policy.
Mm-hmm.
Well, let's say you pull 100,000 out of that. Just
Right.
making up a number. That life insurance policy still continues to accrue whatever the rate is
Right.
based on 100,000. You take the 100,000, you put it into the project that you're doing to rehab through a syndication group. So there might be, what is it, 5 or 10 people in any given project?
It just depends on the project.
Okay, so let's say you have 10 people in the project. And let's say is it a flip? You do mostly flips?
Well, I wouldn't call them a flip. I
But,
mean, we're basically holding them, but it's a shorter period hold.
right. So you're right. So you might be doing a rehab, you're getting it up, you're putting people in, and then you're holding it for a period of time.
Right.
So you're getting now so you're making monies on, if it's rented, you're making monies off the rents as well, right? Because people
Right. Right. Yeah. There's the cash flow.
Cash flow.
That's where you
get and then you'll as a syndication group, you will borrow on that, or you'll get a refi, pull cash out,
right,
and then go into the next project with the same money, right? So now you're making money on the insurance, you're making money on the project. Now you're into another project, and you're also maximizing your write-off through, would you call it segregation?
Cost segregations that we do on the projects, right?
Cost segregations. So now you're magnifying, you're taking money and you're creating multiple streams of return off of $1. You're taking that dollar, and now where's the fourth way? Did I miss something?
Well, there's the cash on cash. There's a depreciation, saving on taxes, and then there's the value add,
which is the extra project,
right? And then on the first project, we also made money on the insurance side too.
Okay, this is awesome. This is stuff you're not going to hear in many places, And so, Marlon, I'm really excited you shared this. There's a couple comments here. Let me just grab a couple. My financial planner kept telling me don't pay extra on the mortgage because I can claim the interest. After I sat and figured it out, I wasn't getting enough back to offset what I would have saved.
Yeah, of course, a lot of people always said, well, I want my mortgage so I get the deduction. So I kind of look at it as like, I mean, all right, but think about this. If you pay $1 into the mortgage and you get 30 cents back because you're in a 30% tax bracket, let's say so you spend $1 to get 30 cents back. I always say, give me that $1, I'll give you 50 cents back, and you got a better return on your money.
So you're spending $1 to get 30 cents back.
Yeah.
Versus the second part, what'd you say?
Well, I'm just kind of joking. I say, well, give me that $1 instead of to the bank, and I'll give you 50 cents back.
Right.
You made 50 cents in a sense. I made 50 cents, but literally, it's. I'm not saying don't get a mortgage, but I mean, we use debt a lot, but it's the banks are teaching you to look at interest rates. They're teaching you, hey, you can get a deduction. Of course, the last tax break or changes, a lot of it's 10,000 max. So, if you got 15,000 in mortgage, you don't even get to write it all off in interest. So,
right,
it's they're actually some of my really wealthy friends, they don't even own their homes. So
well, this is another good point. So let's because I heard this before. Your home is not an asset. I mean, you might get right.
It is in a sense. I mean, you got to live somewhere.
Well, no, I get that. What I'm saying, Marlon, is you just said most people move after 7 years.
But
right?
see, the thing is, you got to define what an asset is. So if it's not making you money, is it really an asset? Well, no.
Well, that's
and so but the other thing is, if you're just paying rent versus, especially with homes appreciating the way they are now, I mean, some of these people, they buy a house 3 years later, I mean, it's 100,000 more. So
let me ask you a question though, because you said you have wealthy friends that don't own homes. What do they do?
Well, they have, in some cases, you might live in a condominium, stuff like that. They rent them and it's actually cheaper. And because of not have to deal with maintenance and upkeep, they're gone a lot. They don't have to focus on it. I mean, there's other reasons why they're in that, or maybe they're, they have it in an entity structure. And so they're renting it from their entity. And there's other ways of doing it than this.
Right. No, I like that. That's a really good these are all great things to set up, but let me just say here's another one. And I also want to figure out, like, where should somebody start? I think this is because we obviously got into some complexity about when you start to get into these bigger strategies, when you know
Right.
what you're doing. But let's hit this question, and then we'll get into, like, where does somebody start if they're not even in the game at all? All right. So this is it with pulling money for an IRA or 401k? Use it.
No, you don't want to do that.
No.
But you can, if you got a lot of IRA money or 401k money, you can self-direct your IRAs. You can create solo 401ks, and you can use that money to go invest into real estate deals. Especially in syndication, it's pretty easy.
But I think the thing here is, if you're borrowing against a 401k and you're going to get life insurance with it,
No, you don't do that.
you have to be looking at
No.
that'll become a withdrawal, and then it'll be a taxable event. You'll have to pay money. You'll have to pay tax on that money that you pulled out of the 401k.
No, you just don't do that.
Yeah.
I mean, once you learn about the insurance and how it works, I mean, we have people that maybe have a lot of money in the stock market, or they have money in other funds that's not really doing anything. And then they're like, hey, this is a better deal. And so they start pulling that money out. And like, maybe I've had friends that they had a real estate deal that made a bunch of money. And so they start funneling that into another life insurance policy to just borrow against that to go do another real estate deal. So
yeah,
this
is great, Marlon. So Marlon, I just want to let everybody know you're going to be speaking here, not this weekend, but next weekend.
Next weekend. Yeah, it's coming fast.
Yeah, it's coming up fast, and you're going to go into more detail about this. And I know you're going to have a lot of questions. I know there's going to be a lot that's going to come from this. But I think it's worth noting where somebody gets started, because, I mean, and this isn't just like you're going to figure it out today, but if somebody has zero, they don't have life insurance, they don't know what to do, like, where can they get started? What could they do to get in?
There's a lot of great information out there on the web. There's some great books to read. It's just, there's misinformation out there too, unfortunately.
Just like
everything. Yeah. So I guess you want to find someone that's kind of doing it. And in fact, when I found out about this system, it's been at least 7 years ago. My first problem was, who knows how to do this? Meaning insurance agents. And I had a hard time finding insurance agents that knew how to do what I knew could be done. And so I went through a lot of different agents just trying to find the right ones. So I guess, if you can find someone that knows how to do this and have experience in it, that's a really great start. But there is a lot of great books and stuff. And if you want to reach out to Marlon at wealthwise.com.
I'm going to put that in. Put that in for you.
I can direct you to, different books that I thought were great books to learn from. And also I've got some agents that I know that I trust them because I vetted them and used them and seen results. And
right.
That's half the battle right there. Because sometimes after a few years, it takes a few years before you really see which policies are doing better and why is that one doing better than this one, and so.
Yes.
And I used to have an insurance license because I got, I think that was in one of our first talks where I talked about how I got screwed over by a life insurance agent. So, because I didn't know, you don't know what you don't know. So, and I didn't know.
It's the who, right? It's the who, it's like,
right.
Who do you know that knows, and now you're somebody. And I know that you have a lot to teach and share in this space. And I know there's a lot of people that are going to benefit from it.
Yeah. After you've been beat up most of your life like that, I kind of like always wanted somebody that would just show me the way. I just wanted someone to say, just here's the way and just make it easy. And I really never had that for the most part.
You became that.
So I guess I just feel like it's my time to help others. If they're willing, I will help them. So.
No, this is great conversation. I'm going to share. Well, let's get to closing thoughts, and then I have a video I'm going to share about this event we have coming up, March 25th.
Yeah.
Marlon's going to be speaking on Saturday. This is exciting.
Yeah.
I'm excited about this event because there's people coming out of the woodwork right now that are just excited to be here, and we have a couple surprises that we're going to be introducing to everybody, and I know it's going to be a great thing. So.
Yeah, the thing is you want to get around people. I was just reading from one of my guys that's in my mastermind group, and he talked about that, about being around the right people, the movers and the shakers in a sense. But I would say your goals is to get educated, find a team that, whatever you're trying to do. Like I found a team, in the real estate space. I don't have to know it all. I just need to know some things. And then find a mentor, someone that is where you want to be. And there's a lot of them out there that are willing to mentor others. So
yeah, and I think
great goals.
And I think when it comes to mentors too, being guided to the right group. Now we are building a community. There's going to be a lot of great people. Marlon's one of them who handles the wealth part, but there's a lot of other things, especially Julie Gandy's coming in talking about inner peace. How many people are dealing with anxious thoughts
especially through the COVID,
especially through the COVID. So we're going to be talking about inner peace. We're going to have Jose coming in. He's going to be talking about mastering the morning and the morning and evening ritual. He basically 10x'd his life just by mastering these mornings and evenings. I know that's going to be a benefit. I have all the Flashpoint content, which is going to be great. And we have a couple of surprises that are in the works right now that I don't want to let it out now.
Give it all away.
But Marlon, I'm going to share this video. I think we got it right. Let's do this. This is what we're planning. This is a little commercial. So let me share this real quick. Oh, it's not going to work. That's right.
Oh,
we got some technical issues today. Let me try one other thing. Here.
Drum roll.
Here we go. I might be able to do it this way. No, it's not going to work.
No.
Let me try one other thing, and then we may have to.
Otherwise, you can put a link, and then they can go to it.
We'll put it up there. We'll get it up there for sure. I'm just having a challenge with it. Yeah, it's something's going on. It worked before, and then it didn't work, but that's okay. Marlon's got great content. We're going to be March 25th through the 27th, and I apologize. I think there's people on here that I can't see all your comments, so forgive me for that. But let me share the link where Marlon's going to be speaking. Marlon's going to be speaking on March 26th. March 26th in the afternoon.
Saturday. Right.
It's a Saturday, yes.
Yeah, so if you're in the area especially, come on out, because anytime you can be around people that are wanting to move forward is a great thing.
It really is. It is. And it's going to be a great environment. So Marlon, we got one more week. What's coming up next week?
Well, next week we'll just kind of expand on this and in a sense about creating the legacy that you want. So
legacy. So moving from.
Well, yeah, because everyone literally, I mean, you don't want to just live your life and poof, you're gone. You want to leave something behind, that lives on. So
true. So next week we'll go deeper into this. You're free to throw your questions out there, and then we're going to talk about legacy. So Marlon, thanks for being with me today.
Absolutely.
And we look forward to next week, because when we do it next week, it'll be days from the event. So
that'd be it'll be 2 days before I fly out. So
so 2 days, So it's going to be great. Lots of fun, everyone. So Marlon, thanks for being here. Everyone, mark your calendar for next Wednesday at 12:30. We'll be back for the final episode of this series, Wealth Building Wednesdays with Marlon Mueller. Mark your calendar. Don't miss it.
Yep.
Bye for now.
Sounds good. See y'all.